Google stock has more than doubled since last April, and honestly, it's a perfect example of how quickly the story on Wall Street can flip. If you go back to early 2025, the headlines were brutal. The general belief was that Google had lost the AI race. OpenAI was seen as the new leader, and Google was being written off as slow and outdated. Fast forward to today, April 2026, and the narrative has completely reversed. Now Google is seen as a leader in AI infrastructure. But here is the key lesson. While the media was arguing, the actual business numbers were telling a very different story. If you ignored the noise and bought Google around $150 in April 2025, you would be up around 120% today. Personally, I bought 600 shares at about $157. Looking back, that was one of the best opportunities I've seen in years. So, why was I so confident? Because Google is one of the strongest businesses ever built. Let's start with the balance sheet. They only have about 13% debt and hold a AA plus credit rating, which basically means they are considered extremely financially safe. Now, here is something interesting. Analysts whose job is to predict earnings have been surprisingly accurate with Google. Over a 1-year period, they are off about 18% of the time. But over 2 years, they have been very close to reality. Why does that matter? Because it gives long-term investors like us more confidence in future projections. Now let's talk growth. Since 2006, Google has grown its earnings at about 23% per year on average. That's massive. Even during the rough patch in 2021-2022, they recovered quickly. And today, they are still incredibly profitable. Around 60% gross margin. That's how much they keep after basic costs. Around 33% net margin. What's left as actual profit? In simple terms, they are not just making money, they are printing it. Now let's look at how they are using that money. Over the past decade, their revenue has quadrupled, and right now they are sitting on about $126 billion in cash and short-term investments. Even after accounting for roughly $67 billion in debt, they still have a huge net cash position. But here is the number that really matters for AI, $92 billion. That's how much they have spent on capital expenditures, basically investing in things like data centers and AI infrastructure. They did not just try to catch up, they spent aggressively to stay competitive. Now, to be fair, companies like Microsoft and OpenAI are still major players in this space. But in my view, this level of investment is helping Google build a very strong long-term advantage. And for the first time, they have also started paying dividends, which is cash returned directly to shareholders. They started in 2024 at 60 cents per share. This year, it's up to 83 cents. That's about 38% growth in just 1 year. So now, it's not just a growth story. It's slowly becoming a growth and income play. Now, this is where things get interesting. Even great companies can become bad investments if you overpay. Right now, Google is expected to grow earnings at about 13.7% per year. But the stock is trading at a price to earnings ratio or PE ratio of about 30. All that means is investors are paying 30 times the company's yearly earnings. Historically, that's on the expensive side. Back in April 2025, you could buy this same company at a PE ratio of around 17. If we compare that to a 5 years average of about 25.6, if the stock drops back to that average, returns might be around 7% per year. If the market stays optimistic, maybe you get 14 to 15%. But if things turn negative and it drops closer to a 15 PE ratio, returns could actually go backwards. Historically, Google tends to run hot for a few years and then cool off. And those cool off periods, that's usually where the best opportunities are. That's the interesting part about high quality growth stocks. Even if your timing isn't perfect, strong earnings can still carry your investments over time. So, would I buy today? Personally, no. I've already sold 500 of my 600 shares and I'm holding just 100 as a long-term position. Because I'm not here to squeeze the last 10%. I'm here for the big moves, and this one is already delivered. I also wanted to reduce my exposure since it had become one of my largest positions. Now, if you bought at much lower price, Holding long term still makes sense. But if you're thinking about starting a new position today, I would be patient. We've got earnings coming up on April 29th. The stock could move higher if results are strong. But right now, the risk to reward ratio just isn't as attractive as it was a year ago. Opportunities like April 2025 do not come often. The key is being ready when they do. Keep an eye on the earnings. I'll see you in the next one.